Well, just when everybody was relaxing after a long 3-day weekend, the Dow comes out and tumbles 500 points at one point during the day before rallying near the end. Pretty ugly day across the board. A lot of it stemming from some politics over in Europe, in particular Italy. We did see the 2-year government bond over there, the yield go all the way up to almost 3%. Now that was a bond yield that was basically zero just a couple of months ago. So a pretty spectacular move there. So we're going to check in to see what all this means for our market posture. And then we're going to take a look at a trade application on one of the stocks that you might see on my shelf behind me. So let's go ahead and get started. Welcome to the Market Outlook video. I'm your host, Brandon Van Zee. It's May 29th, 2018. First of all, welcome aboard. If this is your first time checking out this video, we're happy to have you here. Make sure you subscribe to our YouTube channel by clicking that red button. In addition to that, you can give us a thumbs up if you appreciate these videos and you want to see us continue to do them in the days to come. Also, you can leave comments for us. And then lastly, in our description area, you will be able to find a link that will allow you to sign up for our email list. That way you can be sent any updates that we have along the way regarding these videos. In addition to YouTube, David and I are both heavy users of Twitter as well. We would encourage you to follow us there. My handle is @BrandonVanZee. The Market Scholars handle is @market_scholars. If you get a chance to like and retweet our daily Market Outlook tweets, we'd be very appreciative of that as well. In addition to Twitter, we're also on Facebook. Feel free to jot down that web address that you see in front of you and join the 1,000 other folks that are enjoying themselves in that particular group on a regular basis. All right, with that, let's go ahead and do some analysis on the markets here. Now you can see we're taking a slight deviation compared to what we normally do when we look at the markets. I brought up Italy here just to kind of show you the theme of the day. Notice that Italy, now this is EWI, for those of you that are following along at home, this is chart 4A for the different chart setups that we offer you here at Market Scholars. This is just a normal market forecast chart. So you can see the market forecast indicator down below, and then the background colors of the chart will tell you whether you're bullish or bearish based off of that intermediate term posture on that market forecast indicator. Now you'll notice that I have EWI pulled up here on the chart, and that is Italy. Now this is the stock market of Italy itself. So think of it kind of like SPY or DIA would represent the United States. So EWI took a tumble today, down actually 5.82%. Oof. Imagine if the Dow was down 5% today. It's a pretty ugly move that we see right there. And again, a lot of politics entering into the equation there. In particular, we're starting to see some significant movements amongst some government bond yields and some fears that potentially we might start that domino effect that we saw a couple years ago when we had all the troubles with Greece over in the Eurozone and potentially getting out of the Eurozone, and what's France going to do and what's Germany going to do. So a lot of ugliness all of a sudden creeping up in the Euroland. And you'll notice that this has been kind of a bloodbath for the last couple of weeks here for Italy. We actually were in a fairly decent uptrend, and then kind of in the middle of May, we just started this down move right here. One day after another, led to where we're at today. Now, is this going to be a capitulation type of a move? Hard to say. Remember, this isn't actually showing the volume of the Italian stock market itself. It's showing the volume of EWI. But one thing to be aware of is that the volume today, despite the really aggressive move, clearly it's the worst day price-wise for Italy here recently. But we actually had bigger volume on Friday, as you can see here. So, normally we'd look at a candle like this and ask ourselves, is this a capitulation day after all this lead up, and then finally they just take them out to the woodshed and beat them? Maybe this is a day where you can actually go in there, start scooping up some value, but that volume does leave you wondering if there's still more to come. So this is kind of a cautionary time here, some instability in the Eurozone. So let's now check on how that's going to affect us here in the United States. So let's go back over to the S&P 500 chart now. You'll notice we were down over 1% today, so a pretty aggressive day for the S&P 500. But you'll notice that our posture remains bullish. Reason for that is if you look at this green line down below here on the market forecast indicator, you can see it's still in the upper reversal zone. It's above 80. So you can read it over here on the label if you want. This is the most recent reading. It says 84.48 and falling. So yes, very ugly day. but it wasn't enough to kick that intermediate term line out of the upper reversal zone. So at this point, we continue to have a bullish posture using the market forecast indicator. Remember, there are different ways to set your posture out there. This is not the only one. So make sure you're utilizing as many different techniques as you have available to you. But according to this one indicator right here, we would consider the posture to continue to be bullish at this point. Now remember, we're getting awfully close to 80. We were up here at about 90 just the day before. So we went from basically 90 down to 84. If we had another big day like we did today, we could easily fall out of that upper reversal zone. So we'll keep our eye on it on a day-to-day basis. But at this moment in time, we do still have that slightly bullish posture there on the S&P 500. Let's take a look at chart 4B now. That way we can look at all four indices close to one another. And the one thing that I did want to point out is that once again, we saw outperformance on a relative basis from the Russell 2000. And that is your chart in the lower right-hand corner that I'm kind of circling down here. Notice the Russell 2000 was only down 0.2% today. Again, keep in mind context here. The Dow was down 1.58% today, almost 400 points there when it was all said and done. And the S&P 500 was down over 1%. NASDAQ was a little bit of an outperformer there. I saw some names like Netflix actually held up a little bit better than the typical stocks out there. It was only down 0.5%. Normally that would be a pretty big day, but in comparison to the S&P 500 and the Dow Jones, where we have a lot of truly international players, that's actually a reasonably good day for it. But again, the shining star from a bullish perspective at least is the Russell 2000. Of course, there are some of you that want to be bearish, and so of course you're cheering on the potential of the breakdown of the Dow and the S&P 500. But if you're bullish, like most Americans are with their 401k plans and different things like that, then you're looking at the Russell 2000 and kind of being impressed with its stability. Typically you find that the Russell 2000 is a little bit easier to kind of knock off kilter because it's dealing with small cap stocks, but just the unique environment that we're in right now, where it's the worldwide economy that is being called into question right now, in particular over in Europe, and it's less dicey over here, domestic United States. But when you're dealing with a lot of multinational companies like in the Dow and in the S&P 500 that are headquartered in the US, they're still going to maybe struggle on a relative basis compared to those domestic-only companies that we oftentimes find in the Russell 2000. So you'll notice that Russell 2000 had this long lower shadow there, and we remain within a stone's throw of all-time highs. If we get any sort of a bounce out of the markets here in the next week or two, I would assume that the Russell 2000 will hit another all-time high. So that's where you're finding some strength if you're looking for it. There is one posture change that I should alert you to, and that is in the Dow Jones. Notice up here, the shading just to the right of today's candle is now pink. And so that tells us that we now have a slightly bearish posture using the Dow Jones. So I mentioned before, we still have that bullish posture in the S&P 500, but that mega cap index of the Dow Jones, we now have a slightly bearish. And that happened because that green intermediate line fell out of the upper reversal zone. Notice it's at 77 and falling. And so anytime that happens, we then would shift towards a slightly bearish posture. It's not the end of the world either, but right now, clearly showing a little bit more turbulence there than some of the other indices. Let's take a look at a few other charts here. I'm going to look at the volatility index here real quick, or the volatility setup, I should say. And you can see here that the S&P 500, now this is SPY that we're looking at here, was down 1.15%. And when we have a big 1% move like this, I kind of like to look at this particular chart setup, which is chart 4K. And the reason I like to look at it is because of this kind of line item that's listed in here. The second thing right below the price action. And you can see that today's candle was a 1% move lower. So last time we had a 1% down move was way back over here, and it would have been on April 24th. You can see that candle touched the blue line, just like today's candle is touching the blue line. Again, that's telling us if it's hitting the blue line underneath the zero line, that's a 1% down move. If it were to hit the blue line on the top side, like it did back here with the green bars, that would be a 1% move on the upside. So we did have quite a lot of volatility here from, let's call it end of January through maybe mid-April, but things have been relatively calm since then. But all of a sudden, we're starting to get another 1% move here. Who knows? Maybe we've got a little bit more volatility in front of us again. What I can say is if I were to go to take a look at the VIX chart itself, so let me see if I can find that. Here we are. 4N is the VIX chart. And you can see, boy, we had a massive day. So I was talking last week how there really wasn't a lot to talk about when it comes to the VIX. We didn't really want to spend a whole lot of time on it. But you can see today it came out of nowhere. And I think I even mentioned that one time in the past as well, in the past week or so. I can't remember if it was during these videos or during one of my classes. But anyway, the VIX is not a normal chart where you're looking for trends of higher highs and higher lows and, you know, like you would with a stock. The VIX is more of a situation where it kind of grinds its way lower over time, and then out of nowhere it'll just start spiking. So it's very hard to capture that and take advantage of it. It's useful from an indicator perspective, but it's very difficult to trade the VIX itself. In today's case in point, again, just last week we were sitting down here with the VIX boring us to tears at 12, and all of a sudden it just comes out of nowhere, rises almost $4 today, and that's good for about a 30% move here today alone. So you can see that when the stock market bounced back near the end of the session, the VIX gave back some off the top, because remember they're inversely correlated to one another. But remember, this can be a good thing then for those of you that are looking for premium to sell. So keep that in the back of your mind. You know, it can be sometimes difficult to find juicy enough premiums to justify taking the trade when the VIX is as low as it has been up until today. But this jut higher here does take us back to some of these levels that we saw back in April. So maybe that kind of resets the clock, gives us a little bit more juice out of our credits that we're selling out there in the options world. So maybe that's a blessing in disguise from that perspective. Let's take a few other charts and analyze those as well. Let's go back over here to some 12 grid analysis. And this is your intermarket analysis 12 grid here. And you can see there were some big movements. Again, we already talked about the volatility index, or the VIX here. So let's now talk about treasury yields. And so notice that treasury yields really got smoked today. We were just knocking on the door of 3.1% 10-year treasury yields not too long ago, just 2 weeks ago. Here we are, all of a sudden, treasury yields falling from 3.1% all the way down to where we're at right now, which is 2.76%. So money is flowing back into the risk-off trade. In other words, money is fleeing risk assets and going to where it perceives some safety, in this case, the U.S. government bonds. You can see down below TLT, which is your long bond. You know, we've talked about this when I was doing the Market Outlook video a couple weeks ago, that, hey, don't be surprised to catch a bounce off of this oversold cluster signal. You'll recall we had that cluster signal right there. In fact, let me right click and go to maximize sell here so we can see it a little bit better. So this would have been back on May 17th. We had that nice close above the high of the low day right there, that hold. And so I wasn't necessarily surprised to see it go higher. I assume that could very well be the case after that oversold signal. Where I am surprised is it encountered very little resistance at the moving average itself. Typically, when you find a security that's in a downtrend, that moving average can act as a resistance area as it does a reversion to the mean up there and then bounces off of it back down to continue that series of lower highs and lower lows. But of course, when we're dealing with something like government bonds, politics and macroeconomics can destroy charts, quite frankly, and technical analysis theory. So where do we stand with TLT right now? Well, as a matter of fact, we're kind of up here at this resistance area. We struggled with this area back here on, let's see, it was March 29th and April 2nd there. So that would have been a Friday, Monday, it appears. Somewhere in that time period, we did struggle to get above those levels. And that's basically where we closed today. Now, intraday, we were able to get up and over those intraday highs over here. But by the end of the day's close, we kind of closed within the range of those prior intraday highs. So this has been a very aggressive move. You don't need a whole lot of fancy indicators to determine that when you're looking at this with your own two eyes, the move from right here, which was the lowest point on a 3-month chart, all the way up here, which is the highest point on a 3-month chart, and all of that to occur in basically 12 days, 12 calendar days, is not normal. And so at some point you would expect that there will be some pressure on yields, but again, anything can happen when it comes to politics. If things really start spiraling out of control in Europe, and all of a sudden all of that money is leaving European bonds, and that's why we saw the Italian yield going crazy to the upside, that money might find its way back over here to the United States buying our government bonds. Now remember, this is the government bond itself, not yields of the government bonds. The yields themselves are going lower. So if you pull up TNX, notice this is the yields of the government bonds in the United States. So money might be flowing out of Italian bonds. In other words, people are selling their Italian bonds, forcing interest rates in Italy to go higher. That money might be looking for a bastion of safety, and it might have found it in the United States government bonds. And so when that money flows into government bonds, that sends bond prices here higher and rates lower. Now, of course, you want to take that one level further, you can start thinking about how that's going to start affecting some of the other sectors in the United States. Many of you are aware that we have some interest rate sensitive sectors that are out there. In particular, you find things like REITs, utilities, and a little bit of consumer staples as being interest rate sensitive in that when interest rates are falling like they are today, those areas can do relatively better. On the other hand, you find banks and brokers, insurance companies, a lot of those other financial-oriented companies really struggle when interest rates are falling. And so you find that some of those banks were really falling out of bed. And we'll kind of review that theory here in just a little bit as well. Let's see if there's anything else. Oh, the dollar continues to move. Boy, you usually don't see currency move this quickly, especially the US dollar. But you'll notice down here in the lower left-hand corner, this is just a freight train to the upside right now. Dollar just keeps on cruising. You will notice that crude oil continues to be a little bit of a thorn. And remember, crude oil is considered a risk-on security. So on a day like today where money is seeking safety, it does typically flow out of things that are highly cyclical like crude oil. So not a huge surprise there. But I will note that crude oil did put up an interesting candle here today. Let me right click on that, go to maximize sell. This is a nice looking hammer candle right here at a support level from back here at about, let's call it end of April to early May. And so that could be the start of stability. We'll have to see. A lot of times we can't confirm that till the next day, but that's kind of what you're looking for. You know, you saw on Friday a really ugly candle where we closed near the lows of the session. Very little lower shadow on that candle from Friday. So today, when it looked like things were just going to really start spiraling out of control to the downside yet again for crude oil, really nice bounce that we saw there on an intraday basis to actually close in the upper half of that candle's range. So yes, we were still down 1.5% on crude oil today, but that candle actually gives us a glimmer of hope that maybe there's a little bit of a rebound in store in coming days. So we'll keep our eye on that situation as well. Let's take a look at another 12 grid here. Let's go to foreign markets 12 grid real quick. Here I didn't really want to point out too much other than Israel's the only foreign stock market on the board here in front of us that remains with a bullish posture. That's ticker symbol EIS. And you'll notice that its intermediate line is still in the upper reversal zone. It's at 90.44, but it's falling. But remember, as long as it's above 80, we still consider that a bullish posture. So if it does start falling below 80, then all of a sudden we'd have a clean sweep across the board. You will notice that some of those developed countries that were looking reasonably good a couple of weeks back, they are now starting to fall out of bed as well. A lot of them may be somewhat loosely associated with what's going on in Italy. And so you see the United Kingdom taking quite the tumble here in the last week. We now see Canada trading below the moving average. And of course, Germany now hitting a 3-month low in today's session as well. So this just goes to show you how things can change rather quickly in the markets. And so you need to continue to tune in. Make sure you know what's going on with your money. One thing I will mention about Brazil up here in the upper left is it does appear that Brazil has now had 2 straight oversold clusters. So let me right click on that and go to maximize sell. You'll notice down here 1, 2. These last two candles we've had oversold clusters. Notice that the prior ones we only had one by itself here, one by itself here, one by itself here. So that could represent a little bit more of that capitulation that we're looking for there. It was down 5% today. Remember, Brazil has probably very little to do with Italy, but just known as a risk asset and one that is resource oriented with lots of oil and metals there in Brazil. It's kind of on the pain train with some of those themes here recently. But with two straight oversold cluster signals here, wouldn't be surprised to see a little bit of a reversion to the mean there again. Now, it's going to take a long ways before we get to break this series of lower highs and lower lows. So even if we do get a reversion to the mean, I would not expect a massive move higher. At least that's not how I'd be setting my expectations. But you might be able to play it for a couple bucks to the upside, and that wouldn't be unheard of at this point, at this extreme nature of where we're at with Brazil. Let's take a look now at our sectors. This is chart 4G for those of you that are following along at home. And you can see, like I mentioned before, the S&P 500 in the upper left continues to have that bullish posture. That's why the background color is green. We also have technology still bullish. We have discretionary still bullish. And then look at the bottom. Kind of interesting because it wasn't too long ago where the bottom rung of sectors were our laggards. They were the ones that were in pink and everything else was in green. Remember, we set this grid up for a specific reason. We wanted those defensive areas or those interest rate sensitive areas to all be kind of congregating together down there at the bottom rung. And so it is kind of interesting now, all of a sudden, 3 out of the 4 of the defensive areas are actually the ones that have the bullish posture using that intermediate term, including consumer staples, which we'll talk about here in just a little bit. But you'll notice over here, we've got utilities that are now trading above that moving average. The chart looks a little bit dicey. It's had a big move up and then a big move down. So those aren't really the smoothest of charts. Of the two, I think real estate actually looks a little bit better from a charting perspective right now. Notice that REITs were up basically 0.26% today. And this is a little bit more of a sustainable pattern here. We didn't have a big breakdown below prior support levels the way we did here with the utilities. So the REITs could be an interesting place all of a sudden. If you expect interest rates to continue to struggle here and for money to flow out of the more cyclical names and into some of the safer havens, then it's possible real estate could have some stabilization right here as well. So keep your eye on that particular sector. Before we get to our trade application, let's take a quick look at our yield curve chart. So let's see, that one would be chart 4J for those of you that are following along at home. And you will notice that we did have a widening of the 210 spread here today, just a little bit. You can see that curling just a little bit higher there, but of course that doesn't change the trend. The trend continues to be for those two different durations to continue to tighten to one another. And of course, we're all kind of keeping our eye on the possibility of an inverted yield curve at some point if we see this trend continue to the downside. So keep your eye on that. Right now we got a brief reprieve from that, and we'll see what happens in Europe to see how that affects our yields over here in the United States as well. All right, let's now go ahead and take a look at our trade application example for the day. So for that, I'm just going to come back over here to chart 4A for just a brief moment. Actually, before I do that, let's go over here to the Market Watch tab. I wanted to show you that in the Dow Jones Industrial Average, so I've got the Dow Jones pulled up here. Remember, there's 30 stocks there. There were only 2 stocks that were up today. We had Coca-Cola that was up 0.66%, and Pfizer snuck in there at the very end by rising 2 pennies, good for a 0.06% move to the upside. Otherwise, the Dow Jones really got beat up. And as I mentioned before, some of the biggest decliners out there were in the financial space because of some of those ongoing threats within the Eurozone, and then of course what's going on with interest rates as well affecting them. But notice that JP Morgan was down 4% today. We had Goldman Sachs down 3.4%. We had American Express down 3.3%. And then, of course, General Electric, which has been in its own house of pain for quite some time at this point. They used to have a fairly big financial arm. They were down 3% today as well. But of course, even if they don't have a whole lot of financial exposure anymore, they are considered a risk-on heavy industrial type of a play these days. And so not a good sign when you see that batch of companies leading the way to the downside, at least if you're bullish on the overall markets. So this could be a time where the investors kind of downshift into some of the less risky names out there. And Coca-Cola could very well be one of those names. One of the things I did point out on Twitter this weekend, so again, if you're not following me, make sure you're following me at Brandon Van Zee, all one word. But earlier this weekend, I tweeted out, where was it? Here it is, right here, that Coca-Cola had actually some interesting news all of a sudden. Coca-Cola launches its first alcoholic drink. Now, this is not available anywhere in the world except for Japan right now, so that appears to be a test market. We don't want to get overly excited about it. Maybe it'll fail spectacularly, but something called a Lemon Dew is now available in Japan for those of you that want to check that out if you're over in that neck of the woods. But this is actually Coca-Cola's very first alcoholic drink, which is kind of interesting. If you think about, a lot of the drinks that you could buy in a bar out there, I happen to be a Morgan Coke or a Captain Coke, however you want to say that type of a guy. But there's a lot of you that are Jack and Coke folks. And, there's a lot of different alcoholic beverages you could truly mix with Coca-Cola. And so it does seem like it could be a good fit. Now, I don't know if that's the image they want to give off necessarily, but who knows? Maybe they end up buying Brown-Forman for the Jack Daniels brand, or maybe they have a huge partnership with Diageo over in England if they want to team up with Captain Morgan. Maybe they end up coming together and actually selling some of those beverages that are pre-made that'll be available across the globe at some point. A lot of people have been thinking that carbonated beverages have been going the way of the dinosaur, but of course some of their sales numbers are better in some parts of the world than they are in the developed markets. But anyway, this could be another avenue of growth. What we don't know is how things will unfold for their product line going forward. What we do know is that they were clearly an outperformer in the market today, and that seems a little bit odd outside of the fact that we did have this news. Now, obviously, you're typically going to find some relative outperformance amongst the staples, but remember, Coca-Cola was the only consumer staple within the Dow Jones that was up today. So I think that this news right here about the alcoholic drink actually was a little bit of a spurt higher for that particular company. Of course, many of you are aware that Coca-Cola is a company that I talk about quite a bit in my classes for a couple reasons. Of course, Warren Buffett, whom I'm very fond of, to put it mildly, is a big fan of Coca-Cola, owns about 9% of the company, at least Berkshire Hathaway does. So we talk about it quite a bit from that perspective. But in addition to that, it's a dividend king or a dividend aristocrat. A dividend king would be a company that has raised its dividends for at least 50 years in a row. And if I come over here and take a look at chart 3A, now remember this is our dividend stair-step chart here, you'll notice that as I go over here to Coca-Cola, and by the way, we talked about Johnson & Johnson in my premium class earlier today as well. It has a very rare weekly oversold cluster signal, and it's touching a 3% yield for the first time today since going all the way back here to January of 2016. So just be aware of that. Finally, things have come in for Johnson & Johnson. But anyway, on to another dividend king, in this case, Coca-Cola. And you'll notice here that Coca-Cola has been clearly trading below this orange stair-step line, telling us that we do have a yield here from a dividend perspective that would be considered historically attractive compared to how investors normally will value this particular company's yield. You'll also notice that we're getting a nice little bounce here. So again, we were up 0.66% today, but you'll notice kind of a theme here where this is not the most exciting company on planet Earth, admittedly, but we typically have kind of a move higher, a move lower, a move higher, a move lower, getting some of those cluster signals in there, a move higher, and now a move lower. And you can see we're starting to round that bottom right there. So it does have me wondering if this is a time where we start seeing a little bit of relative outperformance coming from Coca-Cola. Of course, only time will tell there. What we do know is that they do have over 50 years in a row worth of dividend increases, and their current yield is 3.66%, which we would generally view as very attractive. So one way to try to take advantage of that by also incorporating what I mentioned before about that rising VIX today would be to sell a put. Remember, premium today should be loftier across most options contracts than they were just on Friday because the VIX increased so much. And so what we're going to do in today's example here is we're going to look at the July monthly contracts, the ones with 52 days left until expiration. And I typically like to shoot for a 1% return on risk when it comes to selling puts. You'll notice this one is a 0.96, and this is your 41 strike put there in July. So what I think I'm going to do here in this case is I'm going to just sell a couple of contracts. So let's just do 2 contracts here. And so we're selling 2 of the July $41 puts, but I am going to try to get 1% out of it, meaning I'm going to move that from 38 cents to 41 cents to match the $41 strike price there. So get exactly 1% of that strike. I am going to move this to a good till cancel because I'm not expecting to get filled on that immediately tomorrow. Remember, Coca-Cola's stock price would have to come down in order for us to get filled on that. So I'm going to put it in there as a good till cancel order. And that way, if markets continue to be ugly in days to come, if Coca-Cola does give back some of its gains from today, then we have a good chance of getting filled at a very attractive price for such a high quality company. So let's go ahead and click confirm and send that one off and see how we do on that particular trade. All right, well, I want to thank you for joining me here today. A rough day across the markets today. We'll see if we can get any stability going forward. But right now, keep in mind the Dow Jones did go to a bearish posture, even though the other 3 indices continue to hold on to their bullish posture. So right now, if there's a place to be, it might be in the more domestic, small cap oriented stocks that do continue to hold up a little bit better than some of the other areas. But right now, all eyes are on Europe. So keep your nose peeled, your ears peeled, your eyes peeled, everything peeled to the Euroland overnight, because that will really probably dictate how we're trading here in the United States once we get started here tomorrow morning once again. So with that, I want to wish you all the best with your trades and your investments. Have a great night. Goodbye for now.